Welcome back to Investing Talk Podcast.
Today we're looking at UiPath.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis.
Yeah, let's do it.
I mean, for years, UiPath was, pretty much the poster child of that whole high-growth, high-spend software era.
Right. The classic burn cash now, figure out profits later model.
Exactly. But what we're seeing now is a fundamental shift in that narrative.
Yeah.
It's a massive financial inflection point. The company is moving, and I think definitively, toward becoming a profitable, cash-generative SaaS leader.
And that pivot is everything, isn't it? Because it just changes the whole valuation framework. You go from valuing, a story about the future to valuing actual sustainable cash flow.
That's it.
So the big question is, does the data really back that up? Is this inflection point happening right now?
Oh, it absolutely does. And you really only need to look at three key areas to see the whole story unfold. The first is just the quality of the revenue.
Okay.
UiPath's revenue is now so strongly driven by subscriptions, which is what you want to see. It's recurring, it's sticky. In the 9 months ending October 31st, 2024, their subscription revenue hit $63.9 billion.
Wow, $63.9 billion. That's a colossal number.
It is. But it's the growth rate behind it that's even more important.
Yeah.
That number, it represents a 52% year-over-year increase.
52%.
Yeah. And at that scale, growth like that isn't just about winning new logos. It signals they're expanding deep inside their existing customers.
So once they're in, they're not just staying, they're actually growing their footprint across the whole organization.
Exactly. It shows incredible product market fit. When you're selling to big enterprises, you want predictable revenue, and 52% growth tells you this is software that huge companies are, really relying on.
And relying on it profitably, which brings us to the margins, right? The unit economics have to be there.
And they are. The gross margin expansion is, frankly, it's stunning. For that same 9-month period, the gross margin went up to 82%. That's up from 79% the year before.
82% is. Well, that's elite. That puts them in the absolute top tier of SaaS platforms globally.
It really does.
Let's just pause on that 82% figure for a second, because that's where you really see the operational leverage kick in.
Yes.
I mean, that's the ability to grow revenue way faster than your costs. And that jump from 79 to 82, that means every single new dollar they bring in is just significantly more profitable than the last. They're scaling so efficiently.
And you can see that efficiency in other places, too. It's not just in the cost of goods sold. Take a look at their operating expenses, like G&A, general and administrative costs.
Okay.
Those dropped from 19% of revenue down to 18%. So they're getting leaner while growing the high-margin part of the business faster.
That's impressive, but, a 1% drop in G&A, is there any risk that they're pulling back too hard, maybe underinvesting in the infrastructure they'll need for future growth?
That is a critical question.
Yeah.
And I think the consensus here is that this signals efficiency, not starvation. When a software company is young, G&A might be 30–40% of revenue. You're building everything from scratch.
Right, legal, HR, all of it.
Exactly. But once you hit a certain scale, those costs stop growing one-to-one with sales. This 1% drop suggests they've crossed that threshold. Their back office can now handle more volume without a huge increase in cost.
Okay, that makes sense. So we have high quality, high growth, high margin revenue. But the real proof, the cold hard cash, that's on the cash flow statement.
Precisely. That's where you see the business model has matured. The operating cash flow is decisively positive. UiPath generated $174.5 million in net cash from operations in those 9 months.
And that's a 14% year-over-year improvement. That number right there, that growth in cash generation, is probably the single clearest signal that they've made it. They can fund their own growth now.
They don't need to dilute shareholders. They don't need to take on debt. It's all internal.
So if they're generating all this cash, the next big question is, what are they doing with it? And that brings us to management.
Yep, management conviction and capital allocation. Because what they do speaks louder than what they say.
And right now, their actions are screaming, really, through share repurchases.
Absolutely. The buybacks are a massive vote of confidence. Specifically, in October of 2024, they bought back 1.23 million shares, the average price, $12.43.
And that price, that's not random. That's management drawing a line in the sand. They're telling the market, we think our stock is a fantastic deal at this level. It's like they're acting as their own biggest institutional buyer.
And it wasn't a one-off thing either. You can see a clear pattern. They were buying in August at 11.65, then again in September at 12.15,
Yeah.
and then they kept buying in October at 12.43.
So they were buying even as the price was going up. That's not just opportunistic dip buying. That's a systematic belief that the real value is much, much higher.
And they can do it without any strain.
Yeah.
I mean, they have a fortress balance sheet. They're sitting on so much cash. They generated $37.3 million just in interest income.
That's just interest.
Just interest. It gives them incredible optionality.
So if they have so much cash, why prioritize buybacks over, say, a big acquisition or pouring even more into R&D to widen that moat?
That's the classic capital allocation debate,
Yeah.
right? And I think the buyback signals they believe the highest return on their capital right now is their own undervalued stock. They think the market is mispricing this transition.
And they're clearly in it for the long haul. I saw they still had, over $500 million left on their buyback authorization as of October?
$516.7 million, yeah. So the intent is there to keep deploying that cash.
Okay, so the financials are solid. Management is putting their money where their mouth is. Now we have to look outward. What is the competitive moat that's protecting these incredible 82% margins?
Well, the core of the business is RPA, robotic process automation. For anyone listening who's not deep in IT, it just means building software robots to automate repetitive tasks.
Like processing invoices or data entry, the stuff people used to do manually.
Exactly. And UiPath's main moat is their proprietary tech and the deep platform lock-in that comes with it. Their platform isn't just some simple tool. It's a whole operating system for automation that gets woven into a company's core systems.
And once you're that deeply integrated, the switching costs are just astronomical.
They are. It's not just the money. It's retraining everyone, rebuilding all your automated processes, and just risking massive operational disruption. That lock-in is what lets them keep that 82% margin.
And the proof that the moat is working is that 52% subscription growth we talked about. It shows they're still winning deals, even with all the competition. But we do have to talk about the elephant in the room here, the bear case.
For sure.
This market is incredibly competitive. And the biggest threat have to be Microsoft Power Automate. I mean, it's bundled right into the Microsoft 365 ecosystem that everybody already uses.
That's the key risk, no question. The fear is that a giant like Microsoft could start bundling automation for cheaper or even free and just squeeze UiPath on price.
Which would put serious pressure on that 82% gross margin.
It would, but here are the counterarguments. First, that 82% margin is its own defensive weapon. It gives them a massive war chest for R&D. They can afford to out-innovate competitors who are operating on thinner margins.
So they can use that cash to stay ahead on the tech, especially with AI and more intelligent automation.
Exactly. And the second mitigation point is about the broader economy. The other big risk is, a macro slowdown leading to IT budget cuts.
Right. If CEOs are tightening their belts, big projects get delayed.
True, but automation spending is a bit different. Companies use UiPath's tools to reduce costs. When times are tough and you need to get more efficient, automation becomes a necessary investment, not a luxury item you cut.
That's a great point. It reframes it from a nice-to-have to a must-have to drive efficiency.
It becomes a defensive spend.
Okay, let's shift to the future then. What are the near-term catalysts we should be watching for?
The big one, the primary catalyst, is the Q4 earnings report. It's expected in late January 2025. That event is absolutely mission critical.
So it has to prove that all these trends, the subscription growth, the margin expansion, are sustainable.
Yes. If they beat and guide higher, you will almost certainly see analysts start raising their future estimates, and that's what really moves a stock.
And then beyond that single report.
Beyond that, it's the continuous macro tailwind of AI and automation spending. I mean, every corporate leader on the planet is focused on this right now. UiPath is perfectly positioned as a leader in that category.
So if you put it all together, what's a realistic investment horizon here?
I think you can look at it two ways. Short term, there's definitely some swing trade potential going into that Q4 earnings report. A bet on that validation.
But the longer-term story seems more compelling.
Oh, for sure. This looks like a multi-year hold, maybe 12 to 36 months. You're betting on sustained growth and watching for how they strategically deploy that growing mountain of cash.
So it really all comes back to where we started, this idea of a re-rating.
That's it. The market for years priced UiPath as a cash-burning growth company. It hasn't fully caught up to the new reality.
The reality that it's now a profitable, cash-gushing SaaS platform.
Exactly. The company's acting like a mature leader, buying back stock and scaling efficiently. As that becomes undeniable over the next few quarters, the stock could see a significant valuation lift. The market just needs to catch up.
A powerful summary of the whole transition. The underlying numbers are backing up what management is signaling with those buybacks. If you want more analysis like this on companies at major inflection points, make sure you hit that subscribe button and join us for our next one.